Hello everybody, it's Billy Abrams with ADM Securities and A&D Mortgage. It's just after the FOMC meeting today, so I want a quick rundown here. Fed raised rates 25 basis points, sending Fed funds to 5%. This is a number we've been talking about. We look for 25 basis points coming into this, but since last March, when the Fed began raising rates, this is the first meeting where there was a wide range of expectations of what they might do. This is a month ago, or excuse me, about 2 weeks ago, we got a jobs report, the second hot one in a row. Nearly 900,000 new jobs have been added this year versus expectations for about 4.5. With that, expectations for today's move by the Fed jumped from 25 beeps to 50. And then that following weekend is when Silicon Valley Bank collapsed, at which point there began talk of a rate cut today. At the end of the day, consensus had come back to 25 basis points, although I should add that Goldman Sachs was looking for a pause, and even Nomura was looking for a rate cut. So while today came in as expected, this could be bullish news going forward. The statement that was released with it, I only had a chance to scan. I don't think there was any mention in it of the need to raise rates further. There was mention of the term further policy tightening might be needed, but it's a departure from previous statements, and I think probably a bullish one. Prior to the news, early this morning, the 5-year traded at 380. After the news, it traded at 361. It had rallied 10 beeps before the news and then almost a 10 after, so that's important. Also important is the 2-year, which had traded to 4.25 on March 9th. The bank failure came that weekend. In the next 5 days, it rallied from a 4.25, it traded to 5.25 on March 9th. And within a week, it was back at 3.75. This morning, it traded at about 4.25. And after the news came out, it was back down pretty close to 4%. The importance of the 2-year is this. We're about a year into a yield curve inversion. There have only been 4 since the 1980s. And none of them lasted as long as a year. So we're probably not too far from where this curve starts to steepen back out. If the 2-year can stay well below Fed funds, right now it's 100 basis points below. If it can stay well below Fed funds, then as the yield curve steepens, which will carry longer term rates up and rates like mortgages and corporate bonds that trade off of treasuries, they won't have to go as high as everything indicated even 3 weeks ago. So everything about today is probably good news. We may get a better reaction tomorrow than we get today. If you can see the screen behind me, the 5-year is still in a rally. That the big chart there is the 5-year yield, and the horizontal line is where it was right before the Fed news came out. So we'll leave it at that, and we got another meeting coming up on May 2nd, so maybe we visit this again then. Have fun, everybody. Thanks.